You look at a roller coaster and you see steel, speed, and a few minutes of screaming. An amusement park owner looks at that same coaster and sees a $15 million asset that starts losing value the moment it opens, that has to be inspected every single day it runs, and that will need to be replaced by something bigger and scarier in about a decade, or the whole park starts to feel old. That gap between what you experience and what the owner is actually managing is the entire story of why this business is so much stranger than it looks. The instinct is to think of an amusement park like a toll booth. Build it once, then collect money forever, while the upkeep is basically mowing the lawn and replacing a few light bulbs. That mental model is almost the opposite of how this industry actually works. A theme park is one of the most capital-hungry, cash flow-sensitive businesses you can own, and the numbers only make sense once you understand that the ticket you buy at the gate is barely the point. Start with something that surprises most people the first time they hear it. For a lot of regional parks, admission is close to a break-even product. The real profit doesn't come from getting you through the turnstile. It comes from everything that happens after. In 2023, filings from Six Flags showed that an average guest was worth roughly $61 in revenue, about $33 from admission and another $28 from things like food, merchandise, and fast passes, plus a few extra dollars from sponsorships. Once you strip out the cost of running the park, that left an operating margin of around 20%, or roughly $13 per guest. Read that carefully. Admission was barely more than what you spent on nachos and a t-shirt. The gate isn't the business. The gate is the thing that gets you close enough to the business. This is why parks obsess over what the industry calls in-park per caps, spending per capita once you're already inside. It's also why parking now routinely costs as much as a movie ticket, why a churro costs more than it did a decade ago, and why every path in a modern park seems to funnel you past a gift shop. None of that is an accident of design. It's the actual revenue model wearing a costume made of roller coasters. But here's where the picture gets more complicated, and it starts with a question. If food and merchandise are where the money is, why do parks spend so much energy discounting the thing that's supposedly break even, the ticket itself? Because there's a second layer to this business that most visitors never think about, and it changes how the entire company is run. Most large regional parks now sell season passes far below what daily admission would cost across an equivalent number of visits. That looks like generosity. It's actually a financing strategy. When you buy a season pass in February for a park that doesn't open until May, you're handing the company cash months before it has to deliver anything. That upfront money is called float, and it does two things for the operator. It smooths out a business that would otherwise earn almost nothing for 8 months of the year, and it locks you in as a repeat visitor who's already paid, which means you're far more likely to come back and spend on food and merchandise multiple times, rather than once. This turns a theme park into something that behaves less like a one-time attraction and more like a subscription business, closer to a gym membership than a movie ticket. And subscription businesses live and die by a metric most viewers have never heard applied to a roller coaster: retention. If pass renewals slip, the company doesn't just lose ticket revenue, it loses the guaranteed float that was propping up its cash flow all winter, and it loses the higher margin food and merchandise spending that comes from people visiting 5 or 6 times instead of once. That's exactly what happened to the newly merged Six Flags Entertainment Corporation in 2025, when a report showed attendance down by roughly 1.4 million visitors compared to the year before, with season pass purchases also declining, a combination that hits both sides of the ledger at once. So admission funds the gate, food and merchandise fund the profit, and season passes fund the calendar. That's 3 overlapping systems just to keep the lights on. Now add the part that actually explains why parks so often struggle financially even when they're crowded every weekend: the capital treadmill. A coaster isn't a purchase you make once, it's a purchase you make on a schedule, forever. Major new attractions routinely cost anywhere from several $1,000,000 for a mid-size ride to well over $20 million for a marquee coaster. And that number doesn't include annual inspection, maintenance, refurbishment, and the insurance load that comes with operating heavy machinery that flings people around at highway speeds. Skip a year of meaningful investment and you might not notice immediately. Skip 2 or 3 and attendance starts to soften, because in this industry, new is not a marketing word, it's the product. A park that looks the same as it did 5 years ago is, to a regular visitor, a park that's gotten worse, even if nothing is technically broken. That creates a trap. To keep attendance up, you need to keep investing. To keep investing, you need cash flow. To protect cash flow, some operators are tempted to squeeze the other side of the ledger. And the fastest, most tempting place to squeeze is exactly the place you should never squeeze: safety and maintenance. Which brings us to the part of this business that rarely shows up in an earnings call, but shapes almost every decision an operator makes: insurance. A theme park is, from an underwriter's perspective, one of the riskiest things you can insure. You're inviting tens of thousands of strangers a day to be strapped into machines designed to simulate near danger, and asking them to trust that every bolt, harness, and sensor is exactly where it should be. When that trust breaks even once, the consequences don't stay contained to a single incident. They ripple through legal costs, insurance premiums, regulatory scrutiny, and public perception. And all four of those move the same underlying number: how much it costs you to keep operating tomorrow. There is no better illustration of what happens when an operator tries to shortcut that cost than a water park that opened in Vernon Township, New Jersey in 1978 on the grounds of a struggling ski resort.
Action Park was built on a genuinely interesting idea: a summer business to keep a ski resort's revenue flowing year-round, with a founder, Eugene Mulvihill, who wanted rides where visitors controlled their own speed and their own risk. It grew into a 250-acre complex with dozens of attractions, and for its first few years, it looked like exactly the kind of scrappy success story this industry loves: a shoulder season idea that turned into a full destination. Then, in 1982, two guests died within a week of each other, and the park's reputation began to shift from thrilling to dangerous. It didn't stop attendance. If anything, the danger became part of the draw. Locals reportedly nicknamed it Traction Park, and getting hurt there became something people bragged about rather than avoided. But underneath the folklore, the actual business was quietly rotting. Lawsuits from injured guests started piling up, and rather than absorbing the rising cost of legitimate insurance, the company that ran the park allegedly created its own unauthorized insurance entity to cover its own liabilities, a scheme that eventually led to a 110-count grand jury indictment against the companies and executives involved for operating an unauthorized insurance company. In effect, when the real market told the park what its risk was actually worth, the response wasn't to reduce the risk, it was to fake the coverage. That is the moment the story stops being about dangerous water slides and starts being about what happens when a business tries to outrun its own cost structure instead of paying for it.
The consequences compounded from there. More lawsuits meant more settlements. More settlements meant less cash for reinvestment and maintenance, and rides began to be quietly closed and dismantled in the 1990s as costly settlements and rising insurance premiums took their toll and attendance began to suffer. By the time the park closed for good in 1996, it was tied to 6 fatalities, including 3 drownings in the wave pool and a guest electrocuted after his kayak flipped near a submerged wire. The family of the park's first fatality, a 19-year-old thrown from a ride in 1980, later learned the operator's liability coverage had reportedly been arranged through a fake policy based in the Cayman Islands, leaving them able to recover only a fraction of what a real insurer would have owed. This wasn't a park undone by one bad ride or one unlucky season. It was a park that chose, repeatedly, to treat safety spending as an expense to be minimized rather than a cost of staying in business. And the chain reaction that follows is the same chain reaction that shows up, in far less dramatic form, whenever any operator underinvests in the parts of the business that don't show up on a highlight reel. That chain reaction is worth naming explicitly because it's the mechanism underneath almost every theme park failure, dramatic or not. Cut spending on safety or maintenance, and you save money in the short term. That saved money either goes to the owner or gets reinvested elsewhere, but the underlying risk hasn't gone away, it's just been deferred. Eventually, an incident occurs, or a regulator notices, or word spreads. That triggers legal costs and higher insurance premiums, which means less cash available for reinvestment. Less reinvestment means the park starts to feel dated, which erodes attendance and season pass renewals. Falling revenue puts pressure on costs again, and the operator faces the same decision that started the cycle, except now with less money to work with. Action Park is the extreme version of this loop, ending in fraud charges and fatalities. But the same loop, running much more slowly and without anyone breaking the law, explains why so many regional parks quietly decline for years before anyone outside the industry notices. Now here's the counterintuitive part. Modern, legitimate, well-run public companies can fall into a version of the exact same trap, not by cutting safety, but by taking on debt instead. Debt and underinvestment in safety solve the same immediate problem, which is I need cash now and I don't want to raise ticket prices. But debt has its own gravity. When Cedar Fair and Six Flags merged in 2024, the goal was straightforward: combine two companies competing for the same regional guests.
cut duplicated overhead, and use greater scale to extract more spending per visitor. The same food and merchandise engine described earlier, just bigger. The combined company became North America's largest regional operator, spanning dozens of parks with roughly 50 million annual visitors and revenue north of $3 billion. But the merger also consolidated the debt both companies were already carrying, and by the end of 2025, the combined entity was managing $5.2 billion in debt. That debt doesn't sit quietly. It has to be serviced every year, regardless of how the weather behaves or how many people show up. And in November, the company was downgraded by Moody's, which cited integration challenges and lower attendance that hurt earnings as key reasons. To manage upcoming maturities, the company sold $1 billion in high-yield bonds at an interest rate in the low to mid 9% range, a deal one analyst estimated would add roughly $36 million a year in extra interest payments just to refinance existing obligations. A consulting firm founder who works with parks worldwide summed up the pressure bluntly, pointing to weather, tariffs, the broader economy, and rising food prices at the register as forces squeezing attendance at the exact moment the company needed it to grow.
Notice what's happening here. This is the same capital treadmill, the same fixed cost pressure, the same need to extract more revenue per guest, just financed through Wall Street instead of through unauthorized insurance schemes. Nobody is accused of fraud. Nobody is being harmed on purpose, but the underlying fragility is structurally similar. A business with enormous fixed costs, a short operating season, weather dependency, and now billions of dollars in obligations that don't care whether it rains on a Saturday in July. And underneath even that, there's one more layer most visitors never think about at all: the land. A theme park sits on hundreds of acres, often in fast-growing suburban or exurban areas where real estate values have climbed for decades. For a struggling or moderately performing park, there's a version of the math where the dirt underneath the rides is worth more sold to developers for housing or retail than the park is worth as an operating business generating $13 of margin per guest. This is why parks sometimes close even while attendance looks stable, not because people stopped wanting to go, but because someone ran the numbers and found that the highest and best use of that land was no longer amusement rides. Put all of that together, and you get three very different versions of this business, depending on who's running it. At the top sits the Disney and Universal model, where the parks aren't really theme parks in the traditional sense. They're the physical extension of a media and intellectual property business. Guests stay in owned resort hotels for multiple nights, which multiply spending per visitor many times over what a single-day regional guest spends. And the rides themselves double as marketing for movies, merchandise, and streaming subscriptions elsewhere. That model can absorb enormous capital costs because the return isn't measured in ticket price alone. Below that sits the realistic, well-managed regional operator, something closer to what the combined Six Flags is trying to become. High fixed costs, real debt, genuine weather risk, but a functioning engine. Season passes for cash flow, food and merchandise for margin, and enough reinvestment to keep attendance from eroding. It's a business that can be profitable, but it's rarely comfortable. Every rainy summer, every spike in interest rates, every slowdown in consumer spending on discretionary treats shows up in the numbers almost immediately. And at the bottom is the failure mode Action Park represents in its most extreme form, an operator that responds to rising costs by cutting the wrong things, treating safety and honest insurance as optional line items rather than the actual price of admission to running the business at all. Most parks that fail don't end in criminal indictments. They end quietly, with a park that stops adding new rides, then stops maintaining old ones properly, then closes, then gets sold for the value of the land underneath it. So the next time you're standing in line for a coaster, the interesting question isn't how fast it goes. It's how many separate financial systems had to work correctly just for that coaster to still be running this season. A season pass system betting on your loyalty, a maintenance budget betting against bad luck, an insurance policy betting against catastrophe, and often a debt schedule betting on a good summer. An amusement park was never really selling you a ride. It was selling you a recurring reason to keep funding a business that has to spend enormous amounts of money every single year just to stay exactly as thrilling as it was the year before.